Subcommittee on Digital Assets, Financial Technology, and Inclusion will come to order. Without objection, the chair is authorized to declare a recess at any time. This hearing is entitled Next Generation Infrastructure: How Tokenization of Real-World Assets Will Facilitate Efficient Markets. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now yield to myself 5 minutes for the purposes of an opening statement. Last month, the committee made history by ushering in comprehensive digital asset market structure legislation across the House floor with strong bipartisan support. This came on the heels of strong bipartisan support to repeal Staff Accounting Bulletin 121 so that regulated financial institutions would be able to custody digital assets. Although our work with digital assets is far from done, I'm delighted that the subcommittee's focus today will now shift to other related topics. The tokenization of real-world assets is one such area that I'm particularly interested in getting into today. Because tokenizing real-world assets involves blockchains or distributed ledger technology, some might view tokenization as a mere extension of the digital asset conversation that we've been having in this committee for over a year. However, it deserves its own distinct conversation and prioritization. While digital assets are generally issued and managed on blockchain networks, tokenization can bring traditional finance, quote, on-chain. To put this in a different context, tokenization can leverage the efficiency and transparency of blockchains to help modernize U.S. markets. Some components of our capital markets suffer from inflated cost, stranded liquidity, siloed markets, and high barriers to entry. Unsurprisingly, some of these limitations are also present in the banking system as well, where it can take time to transfer funds, reconcile ledgers between 2 different financial institutions. With the help of blockchain, tokenization can automate some of these critical processes within a financial transaction, bringing along streamlined settlement, lower costs, and lowering agency costs is such an important component of benefiting consumers in financial services. Because of the transparency, immutability, compliance programming, blockchains can offer a secure and transparent record of ownership for tokenized assets, which reduces the risk of fraud, errors, and increases trust and visibility into transactions. Many markets could stand to gain from these benefits. We've seen some positive steps in states' adaptation of new amendments to the Uniform Commercial Code. This provides updated rules for commercial transactions regarding digital assets. But unfortunately, we've also seen regulators hinder innovative progress through guidance. Banking institutions, for example, are now required to obtain non-objection or some sort of similar approval process from a federal regulator before conducting any pilot program touching blockchain technology, such as the idea of tokenizing deposits. The private sector should not have to pursue a financial regulator's endorsement prior to exploring the latest innovation in technologies for a possible way to save the company and consumers money and have a more effective product. It's just like evaluating any other operating system enhancement in a financial institution. We need to ensure our regulators are welcoming this kind of innovation to modernize our markets. Today, we're hearing from individuals actively leveraging tokenization to improve and enhance both our capital markets and our banking system. Our witnesses are helping usher in the next age of financial services into the United States, and I'm excited to learn more about the enhancements that they're actively working on, both here and abroad. I hope that we can use this hearing to understand where it makes sense for the consideration of tokenization to be utilized and the necessary regulatory and legal considerations that have to be amended or considered in order to make that more of a reality. I'm also interested to see how tokenization efforts in the U.S. compare to what we're seeing in other capital markets outside the United States. I'm grateful for the witnesses for being here today and sharing their wealth and experience. And I yield to my friend, the ranking member of our subcommittee, Mr. Lynch of Massachusetts, 5 minutes for an opening statement.
Thank you, Mr. Chairman. I also want to thank our witnesses for your willingness to help the committee with its work. As reported by the Financial Stability Oversight Council, the overall value and impact of tokenized assets is still somewhat limited in comparison to the traditional financial system and the crypto asset market. However, the tokenization market continues to expand, and the Boston Consulting Group recently estimated that asset tokenization could reach $16 trillion US globally by the end of this decade. Financial companies are increasingly relying on tokenization to facilitate real-time settlement and payments and improve operational efficiency. At the same time, however, our financial regulators continue to warn us that the growth of tokenization markets could also present corresponding risk to consumer protection, privacy, safety and soundness, and ultimately financial stability and market integrity. That is why it is, I think, entirely appropriate that this subcommittee begins to examine use cases and the potential benefits, risks, and regulatory considerations associated with tokenization. To the great detriment of our oversight function, however, this committee has already unwisely, I believe, moved forward with legislation that will directly hinder our ability to mitigate much risk in this area. Just 2 weeks ago, the Republican leadership put forward the so-called Financial Innovation and Technology for the 21st Century Act. This misguided bill explicitly exempts tokenized securities from long-standing and proven investor protection laws, and it undermines potential benefits that might otherwise accrue from tokenization. I'm concerned that financial institutions will be incentivized to simply tokenize basic securities that are commonly exchanged, and in a way to allow those products to evade compliance with securities law. Indeed, some shareholders might insist that company management use that approach to avoid compliance costs. My colleagues have also attached a bill that requires the SEC and the CFTC to study tokenization, which I think is a wise move. However, this comes just after passing a ban on a U.S. central bank digital currency, which would require studying tokenization. A report by Oliver Wyman found that in 2020, it cost $120 billion. It cost $120 billion to move $23 trillion across borders, and that a multi-currency CBDC could cut costs by 80%, down to about $20 billion. As policymakers, we should consider these technologies long before moving forward with legislation to implement those within our financial system. While it is important that we distinguish tokenization from cryptocurrency, the two have become so interwoven and synonymous that I'm cautious about the risks such as fraud, cybersecurity, and illicit finance. Thus far, it seems the only uptake has been by the crypto industry for tokenization, whose products are primarily used by gamblers and criminals. Despite the warning signs from the crypto industry, major financial institutions, including large banks and asset managers, are announcing their intention to offer tokenized products. As financial institutions consider this path, policymakers should consider the various risks and legal considerations around ownership and transfer of tokens, investor protection, anti-money laundering concerns, and privacy and consumer data protection. Mr. Chairman, I thank you for holding this hearing, and I yield back.
I thank the ranking member. Appreciate his opening statement. Today, we welcome the testimony of Lily Tesler. Ms. Tesler is a partner at Sidley & Austin, where she leads the FinTech and Blockchain group. Robert Morgan. Mr. Morgan is the CEO of USDF Consortium, a network of banks working to integrate tokenized bank deposits into the U.S. banking system. Nadine Chakar. Ms. Shaker is the global head of DTCC's Digital Assets at the Depository Trust and Clearing Corporation. Carlos Domingo. Carlos is the co-founder and CEO of Securitize. Securitize, or through its subsidiaries, is a registered broker-dealer, as well as operates an alternative trading system and transfer agent specializing in the tokenization of real-world assets. And Hillary Allen. Ms. Allen is a professor of law at the American University in Washington College of Law, where she researches the impact of new financial technologies. We thank each of you for being here with us today. You'll be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of our record. And Ms. Tesler, we start with you. You're recognized for 5 minutes.
Great. Thank you. Good morning, Chairman Hill, Ranking Member Lynch, and members of the subcommittee. Thank you for inviting me to testify. It's an honor to be here today. My name is Lily Tesler. I'm a partner at Sidley Austin, where I lead the fintech and blockchain practice. I have over 15 years of experience advising financial institutions and technology companies on the application of securities laws to innovative technologies. 8 years ago, I started representing clients on novel legal issues and implementing blockchain, not only in financial services, but across numerous industries. The views I share today are my own and do not represent those of my colleagues, my law firm, our clients, or any other person or organization. Today, many real-world assets are digitally represented in electronic databases. From manufacturing to retail, most companies manage their inventory, such as widgets, oranges, handbags, through electronic databases. This is largely uncontroversial and has long been true in the world of finance and securities as well. After the so-called paperwork crisis in the late 1960s and early 70s, Congress noted that securities markets, quote, had resisted industry modernization, end quote, and directed the SEC to end the physical movement of securities certificates. We've come a long way and now live in a digital world, so we should embrace blockchain as a tool to provide for more digital capabilities. As background, tokenization refers to the process of digitally representing and recording an asset using blockchain technology. For our purposes, how a blockchain works is less important than what a blockchain is. It's simply a digital ledger. Tokenization can be applied to a wide variety of assets, such as securities, bank deposits, gold, food, pharmaceuticals, or real estate. The act of tokenization does not change the essential nature or character of the asset, nor does it create a new asset class. Rather, tokenization enables the asset to be recorded and transferred using blockchain technology, which offers certain capabilities. These capabilities include improving efficiency, mitigating risk, enhancing distribution channels, providing greater liquidity, and allowing for programmability using smart contracts. Let me share an example of how tokenization of securities works under existing laws. The offer, sale, trading, and custody of these shares involves financial institutions that operate in a highly regulated environment that does not currently provide for an efficient market structure, at least with respect to tokenized private securities. For example, a hedge fund may issue and track its shares as tokenized securities. The method used to record securities is generally a matter of state law, and certain states have expressly allowed the use of blockchain to record securities ownership. However, these hedge fund shares are also sold as private securities under exemptions from the federal securities laws. Tokenized securities rely on the same exemptions as traditional securities, but with the ability to program compliance controls into the token's code. The blockchain information can also be shared with securities market participants in real time, which provides for efficiency and enables a more liquid secondary market. To fully realize a blockchain's capabilities hinges on whether all participants in the securities markets can interact with the tokenized security on-chain. Although tokenized securities can be issued under state law, the securities laws require the use of intermediaries, such as broker-dealers, custodians, and transfer agents, that may not have the regulatory ability to use the blockchain as the official record of ownership or to custody the tokenized securities on-chain. This limits a blockchain's capabilities and creates redundancies, inefficiencies, and risks in the trade flow. The current regulatory guidance may not provide enough clarity and flexibility for market participants to fully leverage the capabilities offered by tokenization. For example, the SEC issued a temporary no-action relief for a new type of broker-dealer called a special purpose broker-dealer to custody tokenized securities. but this broker-dealer cannot custody traditional securities. This distinction creates confusion in the market since a tokenized security is a traditional security but recorded on a blockchain ledger. Tokenization does not change the essential nature of an asset, yet the current market for tokenized real-world assets, at least in the securities space, cannot fully develop until regulations treat tokenized assets the same as the underlying traditional asset. Collaborations among regulators and industry is crucial to provide a clear and consistent path that allows for innovation and competition while protecting investors and market integrity. I urge the committee to continue to learn about the capabilities offered by blockchain and how tokenization of real-world assets can support the United States in being a leader in a digital world. I appreciate the committee's time today and look forward to answering your questions.
Thank you. Mr. Morgan, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, and members of the subcommittee, I appreciate the opportunity to testify before you today. For most Americans, money is already digital and exists largely in the form of bank deposits. These are delivered through a diverse and competitive banking system that ensures individual protections and systemic soundness while supporting credit creation that is the bedrock of a healthy economy. Today, the advent of new technologies promises to reshape the nature of money, how it powers our economy, and shapes our society. Tokenization refers to the use of novel shared ledgers to record, store, and transfer traditional banking assets and liabilities, including bank deposits. Tokenization should not be confused with cryptocurrency, despite similar technological underpinnings. Unlike cryptocurrencies, which are generally bearer assets that exist in novel markets, tokenization refers to the use of distributed ledger technology, or DLT, to improve the delivery of real-world assets, such as bank deposits, bonds, and other regulated financial instruments. Over the years, various ledger technologies have played a central role in banking as a system of record. They've evolved from paper systems to on-premise servers to the cloud. We believe that DLT is the next evolution in ledger technology. Today, financial infrastructure consists of a series of siloed systems, separating banks and even products within an individual bank. Tokenization has a unique ability to break down these silos, facilitating real-time collaboration among financial institutions. In particular, we believe that tokenization can facilitate the following. First, faster, cheaper payments, ensuring customers have real-time access to their funds. Second, programmable payments, automating complex transaction flows that can reduce fraud and improve transparency. Third, atomic settlement. DLT can break down silos between systems, making it easier to buy and sell assets. This added liquidity allows for new funding options that can lower the cost of credit, expanding access to affordable financial products. Finally, collaboration among community banks, and this is particularly important. By allowing groups of banks to work together in real time, they can punch above their weight and compete with larger institutions. This technology is not just about cost savings at banks. It allows for the development of novel products that can benefit the consumers and small businesses that banks serve. For example, USDF's members are exploring how tokenization can improve the construction lending process. By leveraging programmable payments, we can directly tie loan disbursements to the completion of certain milestones, like pouring the foundation of a new building or receiving permitting approvals. This can help contractors and their employees get paid more quickly, reduce risk, and lower the cost of credit, which together could increase the availability of affordable housing. We're also exploring how tokenization can help facilitate loan participations, allowing groups of community banks to leverage strength in numbers. This collaboration allows a community bank to maintain a relationship with a customer who has grown and may otherwise need to find a relationship with a larger bank. USDF is also proud to participate in industry-wide initiatives, such as the Regulated Settlement Network Proof of Concept. This project is a collaborative effort by large banks, payments networks, and other regulated financial institutions to explore how the creation of a shared ledger might improve settlement infrastructure in the United States. USDF's participation ensures that banks of all sizes have a seat at the table as we explore these systems. Despite these promises, at present, there is significant regulatory uncertainty that limits banks' ability to adopt these innovations. Any bank wishing to undertake a tokenization project must receive formal regulatory approval. This is a requirement that does not exist for any other technology. We would encourage Congress to work with the banking agencies to help provide regulatory clarity that will allow banks to responsibly explore tokenization. We would recommend eliminating technology-specific approval requirements for engaging in tokenization, providing clear guidance on the regulatory requirements for DLT infrastructure, clarifying that tokenization does not change the underlying nature of deposits, and promoting public-private partnerships to explore the opportunities for tokenization in financial services. Bank deposits are a cornerstone of our monetary and financial systems that support the dominance of the US dollar around the world. Tokenization promises to upgrade bank deposits, lowering the cost of offering financial services, allowing banks to reach more Americans with safe, affordable, and inclusive products while maintaining the critical protections that banking regulation ensures. We look forward to working with Congress to provide regulatory clarity that can help banks safely and responsibly deliver these innovations. Thank you, and I'd be happy to take any questions you might have.
Thank you, Mr. Morgan. Ms. Chakar, you are recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, and members of the subcommittee, good morning. My name is Nadine Chakar, and it's my privilege to testify before the Financial Services Subcommittee on Digital Assets, Financial Technology, and Inclusion. I serve as Managing Director and Global Head of DTCC Digital Assets, and I'm happy to be here today to discuss our role in driving innovation in the U.S. financial markets through the development of digital technology and tokenization solutions. On behalf of DTCC, thank you for this opportunity. DTCC owns and operates 3 clearing agencies that have been designated systemically important financial market utilities. NSCC, which clears broker-to-broker transactions in stocks, bonds, and other products, provides clearing and settlement services for approximately 200 million transactions a day. And our Central Securities Depository manages lifecycle events such as dividends and corporate actions for over 1.4 million eligible securities. DTCC is literally the heart of the post-trade processing in the United States securities industry. So not surprisingly, we are subject to strict risk management standards and heightened oversight by US regulators, primarily the SEC and the Federal Reserve. DTCC is industry-owned and governed, and we have a long history of innovating purposefully. More specifically to the topic of today's hearing, we have been developing digital asset solutions since 2016. DTCC recently acquired Securency, which now operates within the company as DTCC Digital Assets. DTCC Digital Assets provide institutional-grade blockchain infrastructure to facilitate end-to-end lifecycle processing for tokenized real-world assets. Our goal is to develop technology that could ultimately underpin the evolution of an enterprise-wide digital asset infrastructure. So in other words, we are working to align the company's existing infrastructure with new tokenization capabilities to realize the benefits of post-trade processing of real-world assets in digital form on blockchain. These efforts will allow market participants to unlock the opportunities presented by tokenization, including increased efficiencies in clearing, settlement, collateral management, and payments. I've assumed my role at DTCC when Securency, the company where I had the privilege of serving as CEO, was acquired. The founders of the company and I were gratified that DTCC viewed our technology as offering them the potential to integrate tokenization technology with their legacy systems for traditional securities transaction processing and lifecycle management. I must also say we've learned a few things since joining DTCC. We've become deeply involved in efforts to harden the Securency technology to ensure that it satisfies the incredibly robust requirements for operational resiliency that applies to systemically important FMIs. We've also learned a great deal about the complexity of processes that exist in the industry. And perhaps the greatest lesson of all is that technology on its own won't change the capital markets. It will require collaboration and coordination among all stakeholders, and it needs to be measured and thoughtful. In terms of scale, the benefits of tokenization to mature markets like the US equities and fixed income markets is a tremendous opportunity, but it will take time. This work must be undertaken with due care for the important objective of the existing regulatory framework, including efficiency, resilience, robust financial risk management, transparency, most importantly, investor protection. The gold standard for tokenization, in our view, remains a regulatory framework that largely aligns to and is derived from current financial regulations, following the principle of same activity, same risk, same regulation, while recognizing that there may be areas that need of refinement and/or clarification. By virtually any measure, the United States has the most liquid, efficient, and cost-effective financial market in the world. The critical role that DTCC plays in the U.S. securities market may not be well understood outside of our industry. However, the services we provide benefits all participants in our capital markets, from Wall Street firms to Main Street investors who rely on markets to save for retirement, raise capital to start a business, or obtain a loan to purchase a house or a car. Time and time again, the global financial markets have leaned on financial market infrastructure to drive change. We believe digital securities and tokenization will be no different, and FMIs like DTCC have a critical role to play. We applaud the committee for this timely discussion, and we will continue to engage with Congress and our regulators as they explore these important topics. Thank you, and I look forward to answering your questions.
Thank you, ma'am. Mr. Domingo, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, and esteemed members of the subcommittee, thank you for the opportunity to testify today. It is an honor to be here. I'm Carlos Domingo, the co-founder and chief executive of Securitize. I co-founded Securitize 7 years ago with the vision to provide a regulated path for companies to tokenize their financial assets and issue, sell, and trade securities on the blockchain to modernize capital markets. Early in our journey, we recognized the need to establish registered entities to provide those services lawfully. In July 2019, we registered as a transfer agent with the SEC. Subsequently, in September 2020, we acquired a broker-dealer and alternative trading system license to legally sell and provide a regulated marketplace for trading tokenized securities, and then subsequently acquired the requisite approvals to operate. To date, Securitize has been primarily focused on realizing the efficiencies of tokenization in private capital markets. This large and growing part of our capital markets lacks modern, standardized digital infrastructure. It is encumbered by inefficiencies, outdated intermediaries, lack of accessibility to many investors, and illiquidity, all issues this technology potentially solves. Today, Securitize is the leader in the compliant tokenization of financial assets. We're the largest blockchain-based transfer agent in the US and have pioneered the tokenization of securities in many respects. We've issued dozens of tokenized securities valued at nearly $1 billion. We work with several of the largest asset managers on tokenization projects, including tokenized funds with Hamilton Lane and KKR, and most recently, a tokenized private fund issued by BlackRock, which is now the industry's largest ever tokenized fund. Legislative efforts in the US have been primarily focused on crypto digital assets and stable coins. There has been less focus on legislation enabling traditional financial services and products to benefit from blockchain technology and tokenization. Existing statutes and regulations were not designed with blockchain in mind and contain provisions that can preclude or limit its use in issuing, trading, and settling tokenized securities. This has impeded market participants from using blockchain technology in regulated financial markets and can undermine US competitiveness, given greater progress in other jurisdictions, including Europe, the UK, and Asia. Now I'd like to share a few of my thoughts on opportunities and solutions where new constructive legislation or clear SEC guidance will provide a path for applying blockchain technology to a broad set of regulated financial products. First, we need clarity in the definition of digital asset securities or tokenized securities to distinguish them from other forms of digital assets. This lack of clarity is crucial is today impeding regulators to really understand the unique characteristics of compliant tokenized securities and to regulate them accordingly. Second, today, for broker-dealers to be able to do custody of tokenized securities, they must become the so-called special purpose broker-dealers, or SPVDs. The SPVD framework is frustratingly difficult to achieve, limited in scope, and temporary. It is unclear which tokenized securities are eligible for SPVD custody, and the framework expires in February 2026. We also believe that SPVDs should be permitted to hold payment stablecoins to facilitate efficient on-chain transactions between securities and cash. Today, this is not possible. Third, tokenized securities must be allowed to flourish on public permissionless blockchains, in addition to private permission chains, to realize the benefits of blockchain technology. Any blockchain should be an acceptable market infrastructure for tokenized securities as long as it ensures resilience, stability, risk mitigation, and is subject to a proper technical assessment. Fourth, transfer agents and SEC-registered companies and blockchain-based transfer agents are critical to the tokenization ecosystem and must be recognized as such. We believe that blockchain-based transfer agents should be recognized as the primary providers of tokenization and blockchain transfer agent services after meeting appropriate capitalization, insurance, and technical standards. Fifth, alternative trading systems must continue to be eligible trading platforms for tokenized securities, and peer-to-peer transfers should be sanctioned for investors when wallets are whitelisted and when regulatory transfer restrictions are enforced by smart contracts. And finally, registered ATS within SPVDs must be allowed to facilitate both trading and settlement of transactions in tokenized securities. Tokenized securities can expedite and condense trading and settlement to near real time and enable the merger of trading and post-trading activities, eliminating the need for central securities depositories. This is currently the model chosen by the European Commission for Europe, and US entities should be able to realize similar efficiencies and capabilities. These suggestions are critical aspects of what tokenized securities framework should include. To realize this promise and avoid falling behind Europe and other markets where regulation for tokenized securities is more established, I encourage you to prioritize legislation or encourage clear SEC guidance that facilitates safe, responsible, and compliant tokenization of financial assets as soon as possible. Thank you.
Thank you, sir. Professor Allen, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Lynch, and members of the committee, thank you for inviting me to testify at today's hearing. My name is Hillary Allen, and I'm a professor of law at the American University Washington College of Law and the author of the book Driverless Finance. The first thing I want to clear up today is some confusion between tokenization and crypto. The main point I want to focus on is that crypto runs on permissionless public blockchains and tokenization does not need to. My fellow witnesses have discussed tokenization's benefits of programmability, composability, and atomic settlement, and all of these can be achieved using different kinds of ledgers and databases. This is important because public permissionless blockchains suffer from inescapable inefficiencies and operational fragilities that make them unsuitable supporting infrastructure for real-world financial assets. Now, I know that there's a strong narrative about this being transformative technology. I fell into this trap when I first started writing about Bitcoin nearly a decade ago. I would say things like, the underlying blockchain technology could be revolutionary because that's what everybody else was saying. Well, once I actually started to learn about the technology from independent technologists, it became clear how limited and problematic it really is. Like a square peg in a round hole, permissionless public blockchain technology is a poor fit for the vast majority of problems people have tried to make it solve. First of all, the consensus mechanisms used to verify transactions on these kinds of blockchains are inherently inefficient and wasteful. They have to be, by definition, or else it would be far too easy for a bad actor to take over the system, a system that lets anyone participate. So these kinds of blockchains can't process large volumes of transactions, and the delays and fees can be significant at peak times. Industry experimentation to address these scaling problems often focuses on re-centralizing technological and economic control of certain processes, so why use the public permissionless blockchain in the first place? For me, though, perhaps the most important concern is that these public permissionless blockchains are software, and like any software, they require constant monitoring and maintenance to address bugs and cybersecurity issues. But who has the economic incentive to invest time and effort in maintaining the resilience of a public permissionless blockchain? Most such blockchains rely on core software developers, a handful of them funded by grants and donations, but it is often unclear who they are, what powers they have, who is funding them, or how they are chosen. They are certainly not regulated. Could they be bad actors, or at least have conflicts of interest? Can they always be counted on to get the blockchain up and running again in a timely manner after an outage? What if their funding dries up? What if they just give up on the blockchain? Could the assets hosted on that blockchain be lost? We've heard how heavily regulated most financial infrastructure is. Permissionless public blockchains are just incompatible with that kind of regulation and should not host real-world financial assets. Tokenization should also not be used to integrate real-world financial services with the crypto universe for reasons that I have previously elaborated before this subcommittee. Excuse me. But when performed on other kinds of ledgers and databases, tokenization of real-world assets may be able to promote significant efficiencies in some markets. There is particular interest in tokenizing deposits to increase the speed of cross-border payments, for example. Although I do note that achieving this may require central banks to issue wholesale central bank digital currencies, something that would be precluded if the House's CBDC Anti-Surveillance State Act were to become law. There is also particular interest in tokenizing securities and physical assets like real estate and art, or fractions thereof, and it is hoped that this will increase liquidity and create more investment opportunities. The second major point I want to make today, though, is to urge you not to pin your hopes on tokenization as a means of improving financial inclusion. With so many Americans living paycheck to paycheck, the problem is not a lack of investment opportunities, but a lack of money to invest in the first place. Furthermore, tokenized deposits may speed up payments processing for the already banked, but tokenized deposits will not bank the unbanked. Still, Although it offers very limited paths to financial inclusion, as we've heard, tokenization can increase efficiencies in some markets, and that brings me to my final point. These efficiency gains may be useful, but they may also come at the expense of increased fragilities in our financial system. We should therefore be very thoughtful about where tokenization is deployed. If we think back to 2020, we learned the hard way that supply chains could become brittle in unusual circumstances, and now there's more and more interest in making components closer to home, which is often less efficient, but more resilient. We should think the same way about tokenization. When is something efficient enough such that making it more efficient will introduce too many fragilities and be counterproductive in the long run? I thank you very much for your time.
Thank you, Professor. We'll now turn to member questions and recognize myself for 5 minutes for questioning. Our witnesses have testified about how tokenization can reduce intermediaries, increase liquidity in illiquid markets, and democratize access to investment opportunities. Today, real-world assets such as real estate, commodities, music rights, and collectibles like art exist in silos where they are illiquid and frequently disconnected, but tokenization could bring them on-chain and benefit that. Let's start with you, Ms. Tesler. How does tokenization allow assets to be traded more freely and efficiently across these silos or walled gardens? And can this help bring liquidity and more marketability to something that's obviously illiquid and a very over-the-counter topic like art, for example?
Yeah, so tokenizing real-world assets offers markets the opportunity to leverage the capabilities of the blockchain that I discussed earlier. Tokenization generally involves everyone in the market utilizing a shared ledger. If everyone can look to the same ledger in real time to see the information, this eliminates the need to reconcile across multiple siloed ledgers. Intermediaries can use this same shared ledger to allow for two parties to transact with each other instantaneously using programmable smart contracts. These efficiencies can be realized without sacrificing regulatory compliance, since transfer restrictions, verified identity, and other requirements can be built in right into the smart contract code.
Thank you. Ms. Chakar, DTCC is the most important behind-the-scenes company in the capital markets in the world, probably, and you represent that, and you're doing analysis about how tokenization could reduce agency cost, increase reliability, accuracy, reduce fraud, maybe speed, certainly lower cost, though. But there's also the issue of like margin, and you were very involved, not you personally, but DTCC, very involved in the GameStop mania, where Robinhood, a publicly traded broker-dealer, woke up in the middle of the night trying to make margin, trying to calculate margin of what they had to post because of the GameStop trading mania on their platform. Could tokenization have made that analysis of determining what the margin call was for them more straightforward, more easy, so that instead of working all night and trying to have a conference call at 6 a.m. to post 9 or 10 a.m. Eastern time margin? It seemed like there was a lot of mystery in that and a lot of back and forth. Would having it on a ledger have made that easier?
Well, I can't comment exactly on the specifics that you've described, but yes, one of the attributes that we believe.
So that would like reduce fragility in that instance, potentially.
One of the attributes we believe that tokenization, along with smart contracts, would allow the automation and increase efficiency of margin calculation and margin movement. So you will see an increase in velocity there. So we do believe that's one of the efficiencies, to be able to deliver faster and more efficiently.
Mr. Domingo, recently we heard from a mutual fund company here in the United States that had taken its money market fund and tokenized it, and their cost was reduced so much that they could now offer access to a world-class, highly regulated money market fund at a much lower deposit amount. Meaning, would that increase inclusivity of access to that financial product?
Yes, so I think tokenization obviously provide a much more efficient way of managing the underlying securities of a fund. In many respects, it provides a better fractional ownership for smaller amounts of investments, as you mentioned. It provides automation for things like redemptions, dividend payouts, etc., that can lower the cost of actually maintaining a fund, and therefore This should actually benefit investors by having lower fees and being able to invest in smaller amounts than what today most institutional investors invest on these alternative assets.
Thank you, Mr. Shoker. In the time I've got remaining, these high agency costs things over the counter, like 144A debt, Mr. Morgan talked about bank loan participations. Isn't this the place where this could be the most beneficial in the short run to experiment, determine regulatory supervisory success, accuracy? Would you say that those are some of the markets where this is the most able to be helpful in the short run?
Yes, we believe they are. And we're.
Mr. Morgan, you want to comment about your deposits or loan participation?
Thank you, Chairman. We think there's a tremendous opportunity for tokenized deposits to help streamline particularly complex transactions, cross-border transactions, other multi-party transactions like funding a mortgage. They can have real benefits for consumers and small
Thank you.
businesses.
I appreciate the time. I yield back, and I recognize the ranking member for 5 minutes.
Thank you, Mr. Chairman. Professor Allen, good to see you again. Thank you for your testimony. You write in your written testimony that obviously the tokenization we're talking about today is the tokenization of physical assets. And you compare that, you say, compared to real world assets, many crypto assets are Ponzi-like in the sense that they are not backed by real world assets. And so their value is based entirely on whether another buyer can be found for them, sort of the greater fool theory. Matter of fact, one of the only legitimate reasons to buy crypto is to trade crypto. You need crypto to trade crypto, sort of like a self-licking ice cream. But unless of course you want to avoid government sanctions, or you want to launder money, or you're interested in getting paid for a denial of service hack, then you want to be paid in crypto. Talk about some of the dangers here. There's some great ideas for tokenization. I have to admit that. I think there's some great concepts, for deposits and automatically generated interest and removing all that back office space, a back office function. So there's some great efficiencies that we had here. But talk about some of the risks here, given the fact that we've seen the vulnerabilities in the blockchain sort of arrangement.
Thank you very much for that question. I mean, I think there's several gradations of risk. So, the worst case scenario to my mind is that tokenization, and this was raised by a Financial Times journalist, its primary function right now is to integrate traditional finance with crypto finance, because then we get all the volatility, all of the problems, all of the hacks, everything, having a direct way of influencing our traditional financial markets. And then if something goes wrong, it's not just those who chose to invest in crypto, it's everybody who suffers. But if you take the blockchain out of it and you keep this away from crypto, then as you say, there are a lot of benefits in terms of efficiencies, but there are also risks. A lot of the pre-programming makes things very efficient, but it also makes it rigid. And it means in unexpected circumstances, things can blow up. No computer programmer can think of all future states of the world. They can't cater for everything that could go wrong. And sometimes it's the thing you least expect that causes everything to blow up. So we should be mindful of that. There's some parallels to 2008 and the lead up with creating more and more financial products, making the markets more liquid, but also associating all kinds of rigid contractual rights with them that made it harder to vary things when the world started going south.
And if we have, so let's just sort of think about this. You've got a bunch of different tokenization systems, and you want, ideally, you do want different countries, you want global commerce. Wouldn't you need a central bank, sort of one central, not necessarily reserve, well, sort of like a reserve currency where everybody could exchange their tokenized assets and trade them? Wouldn't that require one central bank currency to sort of settle all that out? That one that everybody recognizes and respects?
Yeah, I mean, I think a lot of the benefits of tokenization depend on there being a settlement asset, right?
Right.
And, you know, some people say that stablecoins should be a settlement asset. I think that is a terrible reason because of all the fragilities of stablecoins that I've testified about before. So I really think that the settlement asset has to be some kind of central bank money ultimately.
All right.
And if you want that on the ledger, it's probably going to have to take the form of some kind of central bank digital currency. Now, this doesn't have to be a retail product, and I want to emphasize that because I'm not sure where I sit on, you know, retail central bank digital currencies, but a wholesale, the plumbing
Yeah.
central bank digital currencies, something like that would be needed as a settlement.
But obviously, if the Federal Reserve Bank is not allowed to operate in that space, it's going to be a central bank, some other central bank. It won't be ours. It'll be, you know, EU or China or some other central bank that'll be the settlement, the central bank currency of choice.
Yeah, I'm not sure how it works without the
So-
US Fed being able to issue us.
The gentleman's time's expired. I recognize the Vice Chairman of the Subcommittee, Mr. Davidson of Ohio, for 5 minutes.
I thank the chairman, and I thank the chairman for specifically scheduling a hearing that isn't about cryptocurrency. It isn't the standard debate between Bitcoin versus shitcoin and everything else in the cryptocurrency world. It's certainly not a hearing about central bank digital currency and what a terrible idea that is. By all means, Mr. Lynch, continue to study it. Know and come to the conclusion that it is a terrible idea to implement a central bank digital currency, particularly the one currently conceived. In fact, this is a hearing about the rest of assets. What are we going to do about the whole rest of digital assets and how they might be tokenized to represent real world assets? So thank you, Chairman, for having a hearing about the much broader part of the market. And so I hope we can move on and have a focus on this hearing topic and not the straw man that some of our colleagues want to continue to pillage. Tokenized securities are real world assets, and several of you addressed that as you spoke, and the chairman mentioned, you know, short squeezes, one in particular. But if you think about the utility of a tokenized security, people will say, yeah, there's certainly utility in custody. It's hard to claim multiple shares. That's one of the problems in a short squeeze. Is there an imbalance in the shares that are pledged? We've dealt with that on any number of issues and in a novel way with MMLTP. But when you look at the implications for securities, people, I think, are building a fallacy that somehow high-frequency trading is going to move to blockchain, and people will recognize there are some limitations on, you know, certain structures for blockchain in terms of execution. So could some of our witnesses address tokenized securities and some of the implications and opportunities there? Mr. Chakar. Mr. Chakar.
Sure. Thank you, Congressman, for the question. To your point, it does require building an infrastructure that is interoperable, which will allow these tokens to move on different networks. And it does require that it starts with compliance as the underlying principle and build up from there. So we do believe it'll become a network of blockchains. It's not one blockchain that will rule them all. There is technology today that allows us to incorporate compliance and rules and make a token a smart token that allows us to actually ensure that a lot of the compliance, AML, KYC sanctions.
But fundamentally, it definitely prevent the double spend problem.
Well, it does it from a perspective that you need a good control location, an entity like DTCC that's actually ensuring that these assets are encumbered, they're not being double spent, to ensure that the integrity and making sure that people have confidence in these tokens that are being. So that is why we keep saying it's you know, the same asset, same risk, same principles, same regulation that will allow us to ensure security and trust in the system.
How do you see that in public versus private?
Private assets.
Yep.
So on the private side, the markets are a lot more liquid and more mature. So what you're seeing there is more efficiency, more speed. On the private side, as Chairman Hill had asked, we do see that shorter settlement cycles. We can take a lot more cost out of the process. We can increase frequency of trading, which eventually would lead to more liquidity. So there are benefits on both sides of the equation.
Thank you. Ms. Tesler, you talked about the important, challenges with the legal framework for the market to even function properly. So if you use distributed ledger technology to store official records of ownership, in Ohio, mortgages or, title to property is one of the things that's under study. As chairman of Housing Insurance, we're paying a lot of attention to that. If you look at the representation of a title to a home or a car, deed to a land or property, what kinds of things, as you look across the market, do we need to address, and where do we need to address them to provide functional markets?
So blockchain, as I mentioned, can be applied across any industries. Certain use cases that we're already seeing, the application of tokenized assets are in the food, drug industry, pharmaceuticals being recorded and food for supply chain movement and tracking to help increase transparency, reduce costs. We're seeing applied to ticketing. Tokenized concert or sports tickets can be recorded and transferred on blockchain to protect authenticity and to build in transfer restrictions. And then certainly real estate is another use case that we're seeing where you can record tokenized title, leases, mortgages, all on blockchain to have the level of transparency.
Thank you all for your expertise, and my time's expired to you.
Gentleman yields back. Votes have been called. It's the intention of the chair to continue with the hearing through the vote until we're ready to adjourn. And with that, I call on the gentleman from California, Mr. Sherman, for 5 minutes.
I've been on the committee for a long time. This hearing harkens back to my first hearing when we focused on the move from abacus to 10-key adding machine. But at that time, the advocates of the new technology did not advocate that they somehow get around our laws designed to deal with money laundering. Professor Allen, in your testimony, you note that public permissionless blockchains are efficient because you avoid all that time-consuming and expensive regulatory requirements dealing with anti-money laundering and the Know Your Customer requirements. A lot of what we're being told is innovative is doing things that we've already done very efficiently for a long time. As Sean points out, the double entry bookkeeping has been invented even before the abacus, I believe. And we're told that innovation is wonderful, but then this Congress passes a bill against even studying CDBC because we now learn that innovation is wonderful only if it achieves two objectives. First, the crypto bros have to be able to make a profit, and the users of the system need a system that efficiently allows them to engage in tax evasion, sanctions evasion, and evading a host of other laws. The Fifth 21 Act included an extremely dangerous title dealing with investment contract assets. This would open the door for existing publicly traded companies to avoid regulation by tokenizing their securities and calling them investment contracts. Professor Allen, in your written testimony, you mentioned that this provision in FIT 21 would be very attractive to issuers who seek to avoid SEC oversight, especially those for traditional securities. What would that mean for retail investors?
Well, I think, if you were a securities issuer and you had the option of opting out of the expense of complying with securities laws, you're going to consider it. And so what you can do is, slap a blockchain on your product, right? Even if it's not a particularly useful piece of technology, as you said, it can be quite useful in enabling you to get around a lot of the regulations. So, if the FIT 21 were to become law, that new Title II would basically allow you to slap a blockchain on any kind of investment contract, and therefore it becomes magically exempted from the securities laws. And
as you point out in your technology, it seems like the real intent here is not to increase efficiency, but to reduce regulatory oversight.
which I guess is efficiency in some people's minds, but it's not efficiency, and it shouldn't be considered beneficial for the public, and I don't think that Congress should be facilitating it.
Now, a couple of times in your testimony, you've hearkened back to your prior testimony that I may not have heard. I hope in your answer you'll summarize your prior testimony. Are there any parts of your prior testimony that you've assumed that we are memorized that you think is important for this hearing?
Apologies. Yeah, no, I mean, a couple of things. Stable coins, as I alluded to in my answer to Ranking Member Lynch, are not a good settlement asset because they are eminently runnable. They also live on this same inefficient blockchain, which can have all kinds of problems. They can,
And these blockchains are not operable with each other. So you live on one blockchain or another, correct? Except for the arbitrageurs can then move back and forth.
They can be made interoperable with something called a bridge, but that bridge, again, has major operational fragilities, and we've seen a ton of hacks of crypto bridges. So yeah, I mean, long story short, stable coins aren't currently used for making payments for a cup of coffee. That's a sort of a narrative that is incorrect.
But the chief, if you invest in a stable coin, you get no interest. You invest in a money market fund, you get interest. The real benefit of a stable coin is that if it ever became a payment system, it could be used to avoid all of our anti-money laundering laws.
Well, right now they're helpful for gambling. You can stake them or use them.
Well, that's one of the laws you try to evade.
Yeah.
Gentleman's time has expired. Mr. Rose of Tennessee, recognized for 5 minutes.
Thank you, Chairman Hill and Ranking Member Lynch, and thank you to our witnesses for taking time to be with us here today. Ms. Tesler, in your testimony, you highlight food items as something that could be tokenized to enhance supply chain visibility. Could you explain how something like steak or eggs could be represented by a digital token?
So as I mentioned earlier, any asset can be tokenized, any real world asset. So the location and authenticity of any produce, so an egg in your example, can be recorded on a blockchain, and then the movement of that produce can be tracked using the blockchain across the supply chain. So different participants on that supply chain can have access to a shared ledger of information to know at any point in time where that asset is. That same information, assuming it's a commodity that's tokenized, could then integrate into commodities markets and can trade, and anyone can buy and sell those assets. So a number of utilities exist for a tokenized commodity.
And go a little bit deeper, if you will, what benefits would that representation of as digital tokens bring to the agricultural industry as a whole, or to the consuming public?
So any type of information can be tracked and traced on the blockchain: location data, temperature, climate, as well as a number of this information integrated with anyone that may need access to that information across the supply chain. And then the efficiencies that blockchain can bring can be passed on to the end consumer, because the redundancies of multiple records along the supply chain with unrelated parties can potentially be eliminated if everyone is looking to the same source of information.
Do you think current technology provides a robust enough connection between these physical assets and the token? In other words, I use as an example, my grandfather 30 years ago gave me a cane. That cane supposedly was given to him by Cordell Hull, former Secretary of State. But I have no provenance of that other than my grandfather's naked claim to that. How does that, in the real world, how do you connect that egg to the token that represents the egg?
So authenticity of and provenance can be tracked and traced and connected to the physical documentation that that you'd have in the traditional world would be linked to the blockchain information.
But subject to the same
Subject to the same
potential
commercial laws and local state laws and others that are already in existence. It doesn't change the existing framework. It kind of adds an extra layer of a place where the information can be stored and transferred.
Okay. And Ms. Tesler, if a banking organization subject to staff accounting bullet Bulletin 121 tries to custody tokenized risk-weighted assets, it has to hold additional capital. However, if the same banking organization custodies a regular non-tokenized asset, it does not have to hold any additional capital. In my view, having two different standards when the risk of the underlying asset is the same doesn't make sense. Do you agree that under the current regulatory regime created by Chair Gensler, we do not have the necessary flexibility to fully realize the capability of blockchain technologies?
Yes, so as SAB 121 is currently written, the definition of crypto assets is very broad. So it encompasses potentially tokenized securities, even if it's a traditional security recorded on a blockchain ledger, which has the impact that a tokenized security has a different accounting treatment under that guidance and different custody requirements than a traditional security of that same asset.
Okay, thank you. And Ms. Chakar, I know that tokenization is a popular topic for foreign jurisdictions and international regulatory bodies. Can you briefly describe how the U.S. regulators have engaged with Depository Trust and Clearing Corporation compared to overseas jurisdictions that seem to be moving ahead faster?
Thank you, Congressman. We're regulated by some 20 regulators around the world. And I do want to repeat my opening statement that we have one homogeneous market in the US, one post-trade. So we're a little bit ahead from our foreign competitors, if you will, that have a more fragmented environment. We have been working with our regulators on a variety of projects. And I'm going to tell you, it doesn't come without its challenges. But what we have been able to prove that constant dialogue in working through the issues at a very granular level eventually leads to success. But it does take collaboration and cooperation on both ends.
Thank you. And Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Mr. Chair. Thanks all for being here. I want to just start by asking us all to be very precise about our language, because we use a lot of words in talking about crypto and blockchain that sound like other words, but they're not really the same thing. Calling blockchain a ledger is like calling a cup of flour a cake, or for that matter, like calling QuickBooks an accounting software, right? It's a piece of it, but just a list of owners doesn't tell you, did you have segregated approval rights and check writing rights? Do you have double entry bookkeeping? Do you even know that all of the owners on this blockchain are real individuals and not some anonymous wallet or something that went through a mixer? And to call that a ledger is disrespectful to ledgers, right? It's just a list of names and numbers. I say that because that's innate to a permissionless public system. And Mr. Morgan, I'm curious because if I understand what you're doing, you are creating a permissioned private system. I'm assuming that's because your members couldn't actually have sufficiently audited books with traditional blockchain technology. Can you talk briefly about what you are building into your system that is not already in the permissionless public system?
Yeah, thank you for the question. USDF is building on private permission blockchain, primarily because of existing regulatory guidance effectively prohibits banks from engaging in public permissionless networks. We believe that infrastructure exists in the same way that any other back-end ledger infrastructure will exist. There are a series of controls on top of that would exist in a traditional payment made today that are applied in the same way when it's done on a private permission ledger as well.
So at the end of the day, will you have a fully GAAP compliant system that would satisfy any Big Four auditor?
That's right.
Okay.
That is our belief.
Professor Allen, is there any way to do that on a permissionless system? And do the people the architects of that plumbing, is there any compliance that they could actually have to make sure that it had those kind of controls?
When you're using a permissionless public blockchain system, you've got to think of the different levels of the stack. The level I was speaking about in my written testimony was actually the operation of the software on which the nodes are running in order to support the blockchain. Then on top of that, you've got the people who actually validate the transactions. And at each level, at both of those levels, a permissionless public blockchain allows for anonymity, essentially. And so with that anonymity, it's it's really hard to get a handle on who's doing what, where. And generally speaking, the big four accounting firms will not touch anything associated with permissionless public blockchains in terms of auditing.
Okay. Mr. Domingo, earlier this year, securitized, tokenized, and distributed shares of a private money market fund issued by BlackRock on the Ethereum blockchain, a public blockchain. My understanding is that any wallet on Ethereum can accept tokens from any other user on the network, right?
That's not correct for the tokens we issue. They're only transferable to whitelisted wallets.
So you put controls to protect against what we're talking about here?
We do, correct. Yeah, this is totally possible on a public distributed blockchain. I'm saying that, providing AML controls or KYC, et cetera, on a public distributed blockchain is not possible. It's like saying it's not possible to run financial transactions.
Okay,
in the public.
well, help me out then, because almost immediately after that money market fund was deployed, internet trolls found the wallet addresses, they sent meme coins, they sent NFTs, tainted funds from Tornado Cash, who of course has been sanctioned by the Treasury Department for money laundering. There were more than 100 cryptocurrencies that were mixed up in legitimate funds that BlackRock had to access that. How is that possibly compliant?
So first, those meme coins and sanctioned tokens were not sent to a BlackRock wallet at all. It was sent to some other wallet that was, labeled with BlackRock. So there was a misperception in the press about what happened. Second, the fact that somebody can send you a meme coin to your wallet, it doesn't mean that the token that represents the unit of the money market fund, which is a security, can be freely sent to some other wallet. Or
Are you suggesting there's a technical solution to this, or that we will have to actually have individuals in the
potentially
loop?
technical solutions. There's other blockchains that prevent assets to be sent to a wallet unless the asset has been pre-approved, and that's something that could be built on top of a public permissionless network without no problem.
Well, I'm fundamentally dubious that you can take the human out of the loop, but I guess in the 20 seconds I've left, do any of you believe that a blockchain system that allows mixers and anonymous wallets can provide a robust ledger of all the transactions and block anti-money laundering?
I do believe so. The same way the internet is also used for legal things and illegal things, and it's a public distributed infrastructure.
I think the industry would be a lot more credible if they were fighting harder before the enforcement actions to protect against money laundering.
Gentlemen's time has expired. And just to remind our witnesses, the chairman, in consultation with the ranking member, will continue questioning till about 200 votes remain, and then we'll adjourn. And I thank the witnesses again in advance for an outstanding participation. And with that, I yield to the gentleman from Wisconsin, the chairman of the House Administration Committee, Mr. Stile, for 5 minutes.
Thank you very much, Mr. Chairman. With any new technology, I think we're always good at identifying potential risks, but I don't think we talk enough about the potential benefits of new technology. And I want to dive in with you to start, Mr. Morgan, if I can. And I'm thinking about community banks here in particular. Historically, ledgers, right, started with paper, moved on into siloed digital formats. This is really an opportunity to, I think, really transform, in particular for community banks. They have a harder time playing in some of this space. But sometimes you'll hear people talk about how this new technology will actually hinder community banks. It will only help the largest financial institutions. Could you provide some clarity about how this might assist some of the smaller financial institutions in our country, which are absolutely essential, in particular for small businesses?
Congressman, thank you for the question. I think this is a critically important aspect of DLT blockchain, is the ability to help multiple institutions work together in real time to punch above their weight. So traditional technology applications have to be sort of spread across a wide customer base so larger banks can have an advantage in adoption. What's unique about DLT is it's that shared infrastructure that can allow for real-time collaboration. So a group of 4 or 5 community banks might be able to band together to make a loan they otherwise wouldn't.
And is that also true in particular as we think about some of these smaller businesses that might be as exporting a product? So a business in Southeast Wisconsin and Janesville, and they export a product, say, to Italy, and they're looking to receive payment. In the current structure, that if they bank with a community bank, there's a delay before that payment would make it all the way through to their account, right?
That's right. And we think.
And then how does this transform with a tokenization? It could be instantaneous, correct?
That's right. And what DLT can do is bring all of those parties to that multi-party transaction together on the same ledger, provide real-time transparency through the transaction so that customer can have real-time insight into how quickly the funds will move, what it will cost them, and when it's received.
And they can do that even if it's a bank holiday in Italy or if it's a holiday in the United States of America, 365 days a year, 24/7. Is that accurate?
That's right.
And under the current system, they couldn't do that, correct?
That is correct.
I want to thank you very much. I want to shift to you, Ms. Tesler, if I can. In particular, I'm thinking about how the Uniform Commercial Code that governs a lot of contracts in our 50 different states. Some states have begun the process of amending the UCC in ways to address this. In others, there's concerns that there might be federal law that's conflicting in this space. You're an expert in it. Could you walk us through what UCC changes may be required and whether or not there's any federal law that needs to be adjusted to facilitate this continued development of technology?
Thank you for that question. So the UCC does not address federal or state regulations. Instead, the UCC provides a default set of rules to govern commercial transactions, and the two can work hand in hand. The 2022 amendments, referred to as Article 12, are now being adopted by various states to respond to market concerns about the lack of definitive commercial law rules involving digital assets. And in Article 12, it applies to controllable electronic records, which specifically excludes the scope of any digital assets that meet the definition covered elsewhere in this UCC, such as deposit accounts, electronic money, and investment property. The nature of the real-world asset does not change when it's tokenized, so the applicable commercial laws to underlying real-world assets still apply, even if it's a tokenized asset. So I think that's important.
Appreciate your feedback. Let me come back to you, Mr. Domingo, if I can, because under the previous question, we heard some discussion about how some of the potential risks to BlackRock, and obviously there's a little back and forth there, but I'd like to discuss kind of the benefit that BlackRock is seeing in particular as it relates to the tokenization of money market funds. Could you just comment on the benefit side of it?
Yeah, I can speak on behalf of BlackRock, but I can talk generally what the benefits of a tokenized fund is. First, it's fully transparent in terms of the holdings of the fund. It's transferable peer-to-peer. In the case of the tokenized, fund that we've done with BlackRock, it's also fully transferable into USDC, which is one of the existing stable coins. So you get 24/7 instant cut off.
And so you have all those benefits, and then just real quick, because I think you were going to explain more further, or you were explaining how you can actually put in place the controls that we all want, know your customer, et cetera. Can you just comment on you in the final 20 seconds here?
Yeah, I think saying that a public distributed blockchain, a permissionless one, you cannot control KYC, AML, or transfer restrictions is a profound misunderstanding of how the technology works. We are a regulated entity, as I've said in my statement, and we do control KYC for the wallets. We whitelist them on chain. We control transfer restrictions using smart contracts, et cetera.
Thank you very much. I think that's really important to have on the record. Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from North Carolina, Mr. Nickel, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thanks to our witnesses. Happy Wednesday. This is the first time the Digital Assets Subcommittee has met since the landmark bipartisan vote on FIT 21. So I wanted to take note of that important bipartisan vote in Congress, the first time we've ever addressed this issue in the U.S. Congress, and thank Chairman Hill and everyone else who worked so hard on this legislation. Very optimistic about the message we're sending to the Senate with 71 Democrats on this legislation. Today's hearing on the tokenization of real-world assets is important. This technology has the potential to truly advance our financial markets. Additionally, bringing tokenized assets into the U.S. financial system will allow greater access to the rapidly growing crypto capital markets. Unfortunately, the SEC's misguided SAB 121 uses an overly broad definition of the term crypto asset, which is defined as a digital asset that is issued and or transferred using distributed ledger or blockchain technology. This definition fails to differentiate the types of digital assets and leaves consumers to rely on lightly regulated foreign custodians. It's unfortunate that Gary Gensler is holding back tokenization technology with SAB 121. I'd like to use this moment briefly to call on Gary Gensler to withdraw SAB 121. I believe he's putting President Biden in a very difficult position on this issue. We have a tremendous executive order and continuous statements from the administration wanting to work with Congress on this issue in a bipartisan manner. And if Gary Gensler were to withdraw SAB 121, we could work in a bipartisan way on the custodial banking piece and these definitions that I think is so important. So that is my hope here. But on to the subject at hand. First question to you, Ms. Tesler. What are the challenges this definition creates with the adoption of tokenized assets in traditional finance?
So as mentioned earlier, SAB 121 is very broad, the definition of crypto assets. So tokenized securities are recorded on blockchain. They are no different than traditional securities. Tokenized stock or a tokenized bond is still a bond or a stock when it's, whether it's in traditional ledger or a blockchain ledger. But the crypto asset definition potentially encompasses the tokenized security. And so this presents challenges from an accounting perspective and a custody perspective for market participants that would need to comply with SAB 121 until some change is effected on that front. I think it's important to remember tokenization does not change the nature of the asset.
Thanks so much. Mr. Domingo, next question to you. The tokenization of real-world assets will improve market efficiency. I think everyone agrees on that. Can you please boil down how this will impact my constituents in North Carolina and give us some of the use cases that are helpful for folks trying to make sense of this issue as they're following what's happening?
So I think capital markets have a lot of inefficiencies that people are not aware of it. And a very simple one that I can mention that could benefit your constituents is how dividends are paid out today in the US. Because there is no ledger where you actually know who the beneficial owners of securities are. Typically, dividends are delayed into reaching the hands of the investors after the company has basically transferred those to the transfer agent, and transfer agent tend to hold the dividends for as long as they can to try to monetize on the asset not being transferred to investors. And I think this technology can improve how money flows from companies to investors, so investors can redeploy their assets and get better returns.
Thanks so much. Last question, Ms. Chakar, to you. Like with any new financial device, the tokenization of real-world assets has risks. Can you explain how Congress and federal regulators should address these issues to ensure consumers are protected?
Congressman, we've been advocating over and over again that the same principles for same activity, same risk, same regulation should apply. So we do believe that the entire community should continue to work on the guidelines that we have around good hygiene, around cybersecurity, risk management, resiliency, and ultimately financial individual protection at the end of the day. We believe the technology can support automating a lot of these functions, and there's no additional risks, if you will, that the technology provide that we don't face in today's environment. We just need to continue to work to monitor and hedge against them.
Thanks so much. We're gonna scurry to votes, and I'm gonna yield back the balance of my time.
Gentleman yields back. I want to thank all of our witnesses for an excellent discussion with our members today. We're grateful for your time as we leave Capitol Hill today. I hope everybody remembers the 80th anniversary of D-Day and remembers the service and sacrifice of the men and women who preserved freedom in Europe 80 years ago. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair. Those will be forwarded to the witnesses for your response. I ask our witnesses to please respond as promptly as you are able. This hearing is adjourned.